Quincy, I tweeted a comment you made last week about the Germans and deficit spending. I wonder, are these headlines significant in your view?
Well, yeah, I mean, the market is sensitive to the headlines. The question really is, and this has been brewing for some time, the chatter about them moving away from a balanced budget to deficit spending. But think about it. They're talking about if Germany goes into a recession. You know, clearly you need to do this before that, and whether or not the $55 billion will be enough. But nonetheless, it has helped the markets today. It helped push up yields. It's helped give a more positive risk-on tone to the market.
David, how much of this three-day bounce now is about policy hope?
I actually think a lot of it is just technical in nature. I mean, this is the Wednesday was the sixth time this year that the Dow plunged at least 400 points. And so what happens is that you get dramatically oversold, and then you fill the gaps, which is technical jargon for a reflexive rebound from these oversold lows. You know, you could argue that, some semblance of fiscal talk out of Germany, if they go into a recession, it's going to be too late anyways. I mean, you could talk about Larry Kudlow trying to calm people's nerves by saying there's no recession. But this rally is 100% purely technical in nature.
Does it give you any comfort, David, the fact that stimulus is coming from all places now, whether it's potentially the German government, the Federal Reserve embarking on more aggressive easing, and other major central banks around the world also joining in on the party? I mean, can that ease the pain here of the sort of dire recession forecast that you have? Well,
I would say the answer to that question is no. And the German government actually hasn't done anything yet. They haven't pledged anything yet. This is all just purely speculation. So if you're going to be changing your view based on speculative chatter coming out of a German newspaper, I think that would be a huge mistake. I think that we've already got the proof of the pudding is in the eating, which is that you're 100% right, Sarah, is that we've had central banks moving more aggressively long before the Fed ever started cutting interest rates at the last meeting. And look at the results. If anything, recession risks globally have gone up, not down. That is what is called proverbially pushing on a string. So I think that people could be hoping there's going to be lots of stimulus, but in a global economy where we're just choking on so much debt, and there's so much geopolitical and trade uncertainty holding back investment spending, that I don't think interest rates are going to do a whole heck of a lot.
So, Quincy, what's your playbook right now? What's your economic forecast, and then how do you factor that into which sectors of the market you're buying?
Well, yeah, I mean, the playbook is that, the economy is slowing, but is it stalling? There's a big difference. And how much does the Fed alleviate some of that pain with interest rate cuts in September and into the rest of the year? So what we've been doing is hedging the portfolio for more downturn, more volatility. That would be your standard treasuries, gold, for geopolitical risk, for example, and the market just tanking. And also REITs. REITs have done better than utilities. You could see it. They're more attractively valued. But the point is, if those yields keep coming down, even utilities, even overbought, will push up. The core of the portfolio, though, is a mix of cyclical and also defensive names, but ones that give you a strong cash flow and dividends. And then on the other side of that is the more risk. Emerging markets, and this is a big if the U.S. dollar comes down against other currencies, emerging markets, the algos will give it an instantaneous bid. And you also have small cap in there, which is volatile and which is risky at this point. The question is, does the Fed give us enough leeway where even small caps get a bid? In terms of sectors, we like some of the consumer discretionary names. The consumer still is doing well. Wages are moving higher. This could change, obviously, if the job market begins to weaken, with the work week weakening even more. It's already started. And we also like the defense names. That is defense, as in Lockheed Martin, General Dynamics. They're doing well. The Pentagon is giving them a lot of money. They have contracts around the world. They have contracts within the U.S. And the defense names are also defensive, by the way. So in the industrial sector, we would be there. Technology, cloud is not going away. Enterprise is not going away. Internet is not going away. So the more they sell off, the more attractive they become.
Oh. That's a comprehensive response, Quincy. Covered the gamut there. Thank you.
That's what you wanted.
Yeah. David, 10-year coming off at 1.5, 30-year coming off at 198. Do you think those are the lows for a while?
No, I think that it's perfectly normal for bond yields to bounce off their overbought levels, much as the stock market has climbed off its oversold levels. So again, this is all purely technical. I believe that recession risks are high and rising. And in a recession, you typically get bond yields going down. The recession, it looks like, hasn't even started yet. As I said, those risks are rising, and all you really have to know is that even if we go one rung above a recession, call it stall speed, we're going to build up deflationary output gaps across the world, and as low as these yields are, and in fact negative in some jurisdictions, they're going to probably go even lower. Certainly in the U.S. Treasury market, I fundamentally believe that the 10-year note is going to close this cycle converging on where UK 10-year gilts are right now, which is well below 1%. So the answer is no, we're not at a fundamental low on yields just yet.